Hello everyone, welcome back to the channel. I hope you are all doing well. In today's video, we're going to break down a developing geopolitical situation involving Donald Trump and China, and why this move is now being closely watched by global markets. Our focus will be on silver, why it is reacting differently from gold, how geopolitical pressure historically feeds into silver pricing, and why some analysts believe silver may be entering a high volatility phase if global tensions continue to escalate. Over the past few weeks, political signals coming out of the United States have grown sharper. Donald Trump, now once again shaping the direction of U.S. policy discourse, has taken a noticeably firmer stance on China. While no formal declaration has been made, policy language, trade positioning, and strategic messaging suggest that economic confrontation is once again moving closer to the foreground. Markets do not wait for official announcements. They react to signals, and those signals are beginning to stack up. China, on the other hand, is responding in its own calculated way. Instead of loud public confrontation, Beijing has been focusing on quiet structural moves, strengthening internal supply chains, increasing strategic commodity stockpiles, and reducing exposure to Western financial pressure points. This is not new behavior, but the timing is critical. When these actions line up with rising U.S. political pressure, markets begin to interpret the situation as more than routine posturing. Silver sits directly at the intersection of this tension. Unlike gold, which is primarily a monetary hedge, silver plays a dual role. It is both a precious metal and a critical industrial resource. This makes silver uniquely sensitive to geopolitical stress, especially when that stress involves China, the world's largest industrial consumer of silver across electronics, solar energy, and advanced manufacturing. Historically, when U.S.-China tensions rise, silver often lags at first. Investors move into gold for safety, while silver remains compressed under paper market pressure. But once industrial demand concerns collide with monetary fear, silver tends to move fast, and often violently. This delayed reaction is one of the reasons experienced traders watch silver closely during geopolitical buildups rather than after conflicts officially begin. At the same time, the structure of the silver market itself adds another layer of risk. Paper silver markets, particularly futures and derivatives, vastly outweigh the amount of physical silver available for delivery. Under normal conditions, this imbalance remains hidden. But during periods of geopolitical stress, when confidence in financial systems weakens, pressure can rapidly shift from paper promises to physical demand. That is where price dislocations begin. Donald Trump's renewed focus on China is acting as a catalyst within this fragile structure. His past presidency demonstrated a willingness to use tariffs, sanctions, and direct economic pressure as political tools. Markets remember this. Even without immediate action, the memory of past trade wars is enough to change positioning behavior among institutions, hedge funds, and sovereign buyers. China's response strategy further complicates the picture. Beijing has been steadily increasing its exposure to hard assets while reducing reliance on U.S.-dominated financial mechanisms. Though official silver reserve data remains limited, China's broader commodity accumulation trend suggests a long-term strategy focused on resource security rather than short-term price stability. When large players think in decades instead of quarters, price signals often lag reality. Another factor driving concern is the broader global backdrop. Energy markets remain unstable, shipping routes face disruption risks, and regional conflicts continue to apply pressure to supply chains. Silver, being essential to modern technology and energy transition infrastructure, becomes a strategic metal under these conditions rather than just an investment asset. This shift in perception can dramatically change demand dynamics in a very short time. What makes the current moment especially sensitive is timing. Political rhetoric is increasing just as silver remains historically undervalued relative to gold. The gold-to-silver ratio remains elevated, suggesting that silver has not yet priced in the same level of risk that gold already reflects. In past cycles, this gap has often closed not gradually, but suddenly. Markets are forward-looking mechanisms. They move not on what has happened, but on what could happen next. Right now, the convergence of Trump's China posture, China's strategic resource behavior, and structural fragility within the silver market is creating a pressure zone. This does not guarantee an immediate breakout, but it significantly raises the probability of sharp movement once a trigger appears. And that trigger does not need to be a war declaration. It could be a sanction announcement, a tariff escalation, a currency move, or even a supply disruption tied to political tension. When confidence cracks, silver historically reacts faster than policymakers expect, and often faster than retail investors can position. As this pressure builds, attention naturally turns to the structure of the silver market itself, specifically the role of futures exchanges and paper contracts. The modern silver price is not primarily discovered through physical buying and selling. Instead, it is heavily influenced by derivatives markets, where contracts representing silver trade in volumes far exceeding the amount of actual metal available. Under calm conditions, this system functions smoothly. But during geopolitical stress, its weaknesses become increasingly visible. The COMEX futures market plays a central role in this structure. On paper, silver supply appears abundant. In reality, the amount of deliverable physical silver relative to outstanding contracts remains historically thin. This imbalance is rarely discussed during stable periods, but it becomes critically important when investors begin to question counterparty risk. During geopolitical tension, trust, not liquidity, becomes the most valuable asset. When political pressure rises between the United States and China, institutional behavior changes. Large funds begin to hedge not only against inflation, but against systemic disruption. Silver, due to its dual role, becomes attractive under these conditions. Yet, the initial movement often remains suppressed as paper selling absorbs early demand. This suppression phase creates the illusion of stability, even as pressure quietly accumulates beneath the surface. History shows that this pattern repeats. Prior to major geopolitical escalations, silver often trades sideways or even declines slightly, frustrating investors. Then, once confidence breaks, sometimes triggered by an unrelated headline, price moves accelerate rapidly. These moves are rarely orderly. They are driven by short covering, delivery stress, and sudden shifts in physical demand. China's position amplifies this risk. As the world's largest industrial consumer of silver, any disruption to Chinese manufacturing expectations directly impacts future demand projections. If trade restrictions tighten, or if supply chains are threatened, manufacturers often accelerate raw material purchases to secure inventory. This behavior creates sudden demand spikes that paper markets struggle to accommodate. At the same time, China's broader strategy suggests preparation rather than reaction. Over the past decade, Beijing has consistently emphasized self-sufficiency, resource security, and reduced exposure to external pressure. While official silver reserve disclosures remain limited, China's actions across energy metals, rare earths, and strategic commodities indicate a long-term accumulation mindset. Silver fits naturally into this framework. Donald Trump's political influence adds unpredictability to this equation. Markets remember the speed with which tariffs were implemented during his previous administration. Unlike gradual policy shifts, Trump-style moves tend to arrive suddenly, often announced publicly and enforced rapidly. This creates gaps between expectation and execution, gaps where markets struggle to reprice risk efficiently. Silver is particularly sensitive to these gaps. Because it trades in both industrial and monetary contexts, its valuation must adjust across multiple dimensions simultaneously. When geopolitical stress hits, silver is forced to reflect not only inflation and currency risk, but also supply chain security and industrial demand uncertainty. Few assets are required to carry such a complex risk profile. Another overlooked factor is investor positioning. Many institutional portfolios remain underweight silver relative to historical norms. This underexposure exists largely because silver has underperformed gold for extended periods. But when narratives shift from inflation to conflict risk, allocation models often change quickly. Rebalancing flows alone can create significant upward pressure. Meanwhile, retail investors often react late. Headlines trigger attention only after price begins moving. By that point, the most aggressive phase of the move may already be underway. This asymmetry between institutional positioning and public reaction is a defining feature of silver rallies during geopolitical crises. The gold-to-silver ratio remains a critical indicator in this context. Elevated ratios historically signal undervaluation in silver relative to systemic risk. When these ratios compress, it often occurs through silver strength rather than gold weakness. Past compressions have coincided with periods of economic stress, conflict escalation, or monetary instability. It is also important to separate probability from certainty. Not every geopolitical signal results in price explosions, but the current alignment of factors, political tension, market structure fragility, industrial dependency, and investor underpositioning, creates a high-risk environment. In such environments, silver does not need perfect conditions to move. It needs only a catalyst. That catalyst could come in many forms: a trade policy announcement, a sanction expansion, a currency response, or even a non-political event that exposes structural weakness at the wrong moment. Markets rarely wait for confirmation. They move when confidence shifts, and confidence is increasingly fragile. As pressure builds, volatility becomes more likely, and volatility in silver is historically asymmetric. Downside moves tend to be slow and controlled. Upside moves, especially during crisis periods, tend to be sharp, fast, and emotionally driven. This is why silver remains one of the most difficult assets to time, and one of the most dangerous to ignore. To understand why silver reacts so aggressively during periods of geopolitical stress, it is necessary to look back at history. Silver's most dramatic moves have rarely occurred during calm economic expansions. Instead, they tend to emerge during moments when political risk, monetary instability, and supply uncertainty collide. Wars, trade conflicts, and systemic crises have repeatedly acted as accelerants rather than causes, exposing weaknesses that already existed beneath the surface. During past geopolitical flashpoints, silver often remained quiet in the early stages. In many cases, gold moved first, attracting defensive capital while silver lagged behind. This delay created a false sense of security. But once confidence in financial systems weakened further, silver caught up rapidly, often overshooting expectations. These moves were not driven by optimism, but by fear. Fear of currency debasement, fear of supply disruption, and fear of paper claims failing under stress. One of the most consistent drivers behind these spikes has been trust erosion. Silver's pricing mechanism relies heavily on confidence in futures markets, custodians, and settlement systems. When geopolitical risk increases, investors begin to question whether paper claims truly represent secure ownership. This shift in mindset transforms silver from a traded instrument into a strategic asset, changing demand behavior almost overnight. This is where extreme price models begin to appear. These models are often misunderstood. They do not suggest that prices will move smoothly or logically to a specific level. Instead, they attempt to measure how markets behave when normal constraints fail. In silver's case, the constraint is liquidity. When physical availability becomes the bottleneck, Prices are no longer governed by marginal demand, they are governed by urgency. China's role is central in this context. As tensions rise, China's industrial planning becomes more defensive. Manufacturers prioritize continuity over cost, securing raw materials in advance rather than relying on just-in-time supply chains. This behavior is rational, but it creates sudden demand surges that paper markets are not designed to handle. When multiple buyers act simultaneously, price discovery becomes disorderly. Donald Trump's approach to China increases the likelihood of such disorder. His policy style is direct and often confrontational, favoring leverage over gradual negotiation. Markets struggle with this unpredictability. Even the possibility of rapid escalation forces institutions to reevaluate exposure, particularly in assets linked to global trade and manufacturing. Silver sits directly within this vulnerability zone. Another factor often overlooked is the feedback loop between price movement and narrative. As silver begins to rise, attention follows. Analysts revise forecasts. Media coverage increases. This attracts additional capital, not because fundamentals have suddenly changed, but because perception has. In markets, perception can move faster than reality, and silver is particularly sensitive to this dynamic. At the same time, volatility itself becomes a signal. Rising volatility forces risk managers to adjust positions. Short sellers reduce exposure. Hedging costs increase. Liquidity thins. Each of these adjustments adds fuel to the move, even in the absence of new information. This is how silver rallies often transition from controlled advances into sharp spikes. It is important to emphasize that these moves are rarely sustainable in the short term. Silver's history is filled with rapid advances, followed by equally sharp corrections. But the path matters. Those who wait for confirmation often find themselves entering near the peak, while those who understand structure and timing recognize the build-up phase long before headlines turn urgent. The current environment shares several characteristics with past stress periods: elevated geopolitical tension, fragile supply chains, high leverage within financial markets, and widespread underestimation of tail risk. Silver does not need all these factors to align perfectly. It needs only enough pressure to expose imbalance. What makes this moment different is scale. Global markets are more interconnected than ever. Supply chains are more complex. Financial leverage is higher. And geopolitical rivalry is increasingly explicit. These conditions amplify both risk and reaction. When silver moves in this environment, it does so with greater force and less warning. None of this guarantees a specific outcome. Markets are probabilistic, not deterministic. But probability increases when multiple independent risks converge. Trump's China posture is one such risk. China's strategic resource behavior is another. The structure of the silver market itself is a third. Together, they form a framework that demands attention rather than dismissal. As investors and observers, the key question is not whether silver will move, but how prepared markets are for that movement. History suggests preparation is often insufficient. By the time price action becomes obvious, structural pressure has already been building for months, sometimes years.